Welcome to the presentation on the capital spectrum. This is a strategic guide to funding instruments. My name is Khavar Nehal and I represent Applied Technology Research Center. In this presentation, we are exploring the capital spectrum. This is not just a list of funding types. It is a strategic framework for matching financial instruments to your specific business objectives and projects. As the CEO of ATRC, I have seen how misaligned capital can break even the best businesses. We will move beyond basic definitions to understand the strategic utility of each tool, from equity to debt, and how our project equity method creates modular, resilient capital structures for sophisticated investors and business owners. We shall also provide some examples of projects available for funding and the types of funding which we feel are suited to them. Why does structure matter more than the amount? Because misalignment is fatal. Traditional venture capital demands hypergrowth that may not fit your model, while traditional bank debt requires rigid payments that can strain your liquidity during lean months. Our goal is to select instruments that perfectly match your cash flow profile and risk tolerance. At ATRC, we believe that capital should be modular. You would not use a sledgehammer to fix a watch. Similarly, you should not use venture capital for a stable service business. Do not just raise money. Architect your capital stack for resilience and alignment. We have been looking at this subject since the 1990s. That is when we found out that the risks associated to founders and companies of venture capital. We also learned how investors like Warren Buffett were able to come up with structures to get funding while keeping control of the business. First, let us look at early stage financing. This is trading ownership for scale. Investors receive shares, meaning there is no repayment obligation, but you face permanent dilution. This starts with FFF, meaning friends, family, and fools, who provide the earliest capital based on high trust. Next are angel investors. These are high net worth individuals from your personal network. Then comes venture capital, which are institutional firms seeking massive returns and usually board control. This is best for high-growth startups. However, be cautious. VCs bring high pressure for an exit and a significant loss of autonomy. Let us deep dive into the earliest stages of equity. Friends, family, and fools provide the foundational capital based entirely on personal trust. While it is accessible, this carries high personal risk if the business fails. Angel investors are the next step. These are high net worth individuals investing their own money. Beyond just capital, good angels provide valuable mentorship and open doors to their industry networks. This stage is best for proving a concept. However, mixing personal relationships with business risk requires clear, professional documentation to protect both the business and the relationship. The highest danger of FFF is that if you mess up, the family cannot be changed. They stick around and can become a negative reference for life if not properly understood and managed. After more than 3 decades of observing the funding area, I have boiled it down to a simple formula. If you do not have revenue, then funding shall have strict terms like VC terms and shall most probably control the business and replace the founder within a year or two. If the business has paying clients and also has a profit, then it is better to ask for funding then, even if the revenue and profit is low. The existence of the profit and revenue proves the viability of the problem-solving capability of the product and/or service that the business is providing. Therefore, the founder has the opportunity to dictate more favorable terms for themselves. For example, keeping control of the business even after it is funded. At the institutional level, we have venture capital and private equity. Venture capital firms manage other people's money and seek massive 10 to 100 times returns. To achieve this, they demand board seats and significant control. Private equity, on the other hand, invests in mature companies. Their focus is on restructuring, buyouts, and optimizing cash flow for operational efficiency. These instruments are best for hyper-growth scaling or preparing a mature company for an exit. The caution here is clear. You will likely lose founder control and face intense pressure to exit. Losing control can also mean higher risk for having people like VC representatives controlling decisions and running the business into the ground faster because they do not understand what the customer wants. Since most VC-backed businesses go under, it also carries the risk of the founder's reputation to be going under with it. So the founder ends up wasting a lot of years if a VC-backed business goes under. The VC system can be used in cases where the founder is very sure of the business and still wants to take chances of hyperscaling and take on the risks of moving fast. Also, the founder can set terms with the VCs to let them run the business for at least a certain amount of time, like 4 times longer than what the founder expects it needs to get the hyperscale results. Next is debt financing. This offers leverage without dilution. You borrow capital and repay it with interest, giving lenders a senior claim on your assets. This includes traditional bank loans, which require collateral and a credit history, bridge loans for short-term gaps, and mezzanine financing for late-stage growth. This is ideal for asset-heavy businesses or those with very predictable and stable cash flows. The caution here is rigidity. Fixed payments must be made regardless of revenue, which can strain the liquidity during economic downturns or seasonal slumps. This can also be used for invoice financing. Here is the sweet spot: hybrid and structured instruments. These blend debt and equity to align incentives. Convertible notes start as debt but convert into equity at a discount later, offering downside protection and upside potential. Safes are simpler but lack debt protection. Revenue sharing notes allow repayment via percentage of the gross revenue until a cap is reached, aligning directly with performance. These are best for growing service firms and software as a service products. At ATRC, we focus heavily on revenue sharing notes and convertible notes for their flexibility. Let us compare 2 popular early-stage instruments, the SAFE and the convertible note. A SAFE, or Simple Agreement for Future Equity, has no interest rate and no maturity date. It is a pure equity conversion with no debt downside protection. A convertible note, however, functions as legal debt until a triggering equity event occurs. It accrues interest and has a strict maturity date. Use a SAFE for very early stages with high trust and a need for fast closing. Use a convertible note when sophisticated investors demand debt-like downside protection before committing their capital. Let us deep dive into revenue sharing notes. This is performance-aligned capital. The mechanism is simple. An investor provides capital and you pay a fixed percentage of your monthly gross revenue. Payments continue until a cap, such as 1.5 times the principal, is reached. The advantages are clear. It offers flexibility because payments drop in lean months, preserving your cash flow. It ensures alignment because the investor only succeeds if you sell. And crucially, there is no dilution. You retain full ownership. This is ideal for recurring revenue models. Now let us look at convertible notes again in detail. This instrument offers deferred valuation and equity upside. The investor lends money as debt, interest accrues, and upon your next major equity round, that debt converts into shares at a discount. The advantages are speed, as it is faster to close than a priced equity round, and protection, since it is senior to equity in liquidation. It offers upside by participating in future valuation growth. This is ideal for early-stage ventures that expect a major funding round within the next year or 2. Category 4 is project finance, which we call the project equity method approach. This involves funding a specific project, such as our ATRC backup server, where repayment comes only from the project's cash flow. We create a separate cap table or ledger for each project. Investors buy into the project, not the entire company. This isolates risk and makes success directly measurable. It is best for product launches, research and development initiatives, or distinct business lines. At ATRC, we use this to commercialize proprietary tools while keeping our core services independent and secure. We also have a complete certification and training program for this method. Let us look at the PEM mechanics in action. The project equity method treats each initiative as a standalone financial entity. We achieve this through a separate ledger or a special purpose vehicle. The capital raised is strictly ring-fenced for that specific project. For example, with the ATRC backup server, investors fund only the software development and the sales efforts. Their returns are generated solely from the software shareware revenue. The primary advantage is that it isolates risk and protects the core business assets from failures or liabilities of a single new initiative. Category 5 is non-dilutive funding. This is essentially free capital for innovation, requiring no repayment and no equity exchange. This includes government grants for research and development and export promotion, corporate grants from tech giants, and prizes from hackathons or competitions. This is best for high-risk research and development or public good initiatives or early-stage validation where you want to preserve ownership. However, be cautious. These sources often come with a high administrative burden and strict compliance requirements that can distract from the core operations. Finally, Category 6 is internal funding, the most underrated source. This is capital generated from within your own operations. It includes bootstrapping with personal savings and retained earnings, securing customer prepayments for annual contracts, negotiating vendor financing for longer payment terms, and asset-based lending against receivables. This is best for maintaining control, testing new ideas, and building resilience. Remember this key insight: your best investor is your next paying customer. They validate your model and fund your growth without taking any equity or imposing any debt covenants. To provide context, let us look at the ATRC ecosystem. We have the Applied Technology Research Center operating since 1992, handling core IT infrastructure and consulting. We have Muftasoft registered since 2005, focused on software and training. And we have Remote Support LLC, which is our US-facing entity for scalable managed services. Our funding strategy maps directly to these entities. Core services are funded via revenue sharing and internal cash flow to maintain stability. New distinct products are funded via the project equity method to isolate risk and attract specific capital. Here is our strategic selection matrix. It helps you match the instrument to your business profile. If you have stable cash flow and want to keep ownership, choose revenue sharing notes or bank loans. If you have volatile cash flow but want to keep ownership, look at convertible notes or venture debt. If you are willing to dilute, private equity suits stable firms while venture capital suits high-growth startups. At ATRC, we operate in the top left quadrant, which is stable cash flow with a desire to keep ownership, using revenue sharing notes and project finance. There might be some projects which we do in-house or in collaboration, which might be okay with other types of funding. For details on the many possibilities, it is advisable to contact and stay in touch to keep updated of the types of fundings available and the types of projects being planned. Before closing any deal, sophisticated investors rely on due diligence checklists, and we embrace this through radical transparency. First, a formal private placement memorandum must detail specific risks, the use of funds, and legal disclaimers. Second, we provide 3 scenario financial models showing base, worst, and best case projections. Third, we enforce strict accredited investor verification in compliance with SEC or local SECP guidelines or the financial regulators of the other countries where the joint venture project is being implemented. Finally, the subscription agreement serves as the binding legal document. Our goal is to build absolute trust through transparency and strict compliance. Thank you for your time. The next step is to architect your capital stack. I invite you to review our private placement memorandum for current opportunities and discuss how the project equity method can structure your next initiative. Whether you are an investor looking for aligned returns or a business owner seeking resilient capital, we are here to help. Please contact me directly via email or mobile or visit our website. Let us build something sustainable, transparent, and profitable together.